Are you looking for a friend in financial services? Someone you can trust to guide you through the maze of options that exist for investors today? Well, you've come to the right place. Today's Master of Money program is produced exclusively for you. And today, we're going to be talking about an innovative new way to invest, something called Folio investing. So stay tuned for today's Master of Money.
This Master of Money program is brought to you by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses, and by Superstock Investor, providing institutional research to individual investors. This Master of Money program was produced Tuesday, April 28, 2015.
Hello again and welcome back to the Master of Money program. I'm Steve Beeman, your host, and as always, I want to thank you for sharing this 30 minutes with me and the society to help you build a better path to prosperity. Tonight on the program, we're going to be talking about a relatively new invention of Wall Street, something called folio investing. This is a little bit different twist on the old asset allocation and portfolio management concepts, so I think you're going to enjoy it, and I think it will present you with some very new ideas. So definitely stick around. Now tonight, I wanted to bring you a special guest, by the name of Jason Wenk. He's a very good friend of mine. I think when you finally do get to meet him, you'll be as impressed with Jason as you are with Jeff Garbaz and Tim Newell. But unfortunately for me, Jason is in Italy on vacation, so he was unable to join us for this program. So we look forward to having him in the future, and we'll be glad to make that introduction to you at that time. Last week on the program, as you may recall, we talked about how to look for that advisor. This is the second or third time in the last year I've talked about this with people. The reason is because it's so critical, and so many of the folks I talk to aren't happy with their advisors. Well, I talked with you about how they're compensated, be they fee-based or commission-based. I talked with you about licensing, whether they hold a Series 7 or a Series 65. And I talked with you about whether their standard of performance is that of a prudent man or is it that of a fiduciary. That's a very important distinction for you. And then finally, I spoke with you about the chemistry that's needed between you and your advisor. This is a very active and ongoing relationship that you have. And in order to maximize the value of the plan that you build for yourself and execute on it properly, well, you've got to have an advisor that you're comfortable working with. So we hope that program was helpful for you, and I do appreciate the feedback that I got on it. But as always, with questions about that program or any other program we have, write to questions@safefinancial.org. We're happy to answer those right away for you. And looking into last week's mail, I had a person who wrote me, and they had just come out of a seminar from Dave Ramsey. I respect Dave, and I think he does good work, but this person wrote to me and said, Steve, is it always a good idea to be totally out of debt? Well, Mr. Ramsey and I have a little different opinion on this. The fact of the matter is he teaches people, without any exception, get out of debt. And I think for most people, that's really good, sound advice. But here's where the society would differ just a little bit. For some of you who understand money and understand business, you know how to make productive use of capital. In that circumstance, if you have the right mindset, the right mentality, and the right purpose, it can make sense to borrow money. Certainly businesses do it all the time, but even for you, if you can borrow money at 1% and turn around and invest it at 4, 5, 6%, well, that makes pretty good sense. It assumes, though, that you have the discipline not to spend the borrowed money. Make sure that you invest it. And that's an area I find many people break down. But if you're one of those people who has the self-discipline to make sure you invest, not spend borrowed money, and you can borrow it at 1 or 2% and invest it at 5 or 6, well, you're being your own bank in that case, and you're making that spread. It's just what the big banks do, so why wouldn't you want to do that? Again, that's a case-by-case basis, so we don't want to blanket say everybody should do it, but it is something to consider as you develop your own personal path to wealth. So we want to thank that gentleman for writing. Once again, you can always reach us at questions@safefinancial.org. And I've mentioned before, if you'd like to view the archived shows, both of the Master of Money and our Safe Insights, feel free to visit safefinancial.org and click on the Safe Financial Network. Now, moving into the geopolitical area, again, what a week it's been, busy around the world. Certainly all eyes continue to be focused on Greece. We talked last week about how they're coming up against some severe deadlines to make payments on this debt they have. Otherwise, the nation of Greece goes into bankruptcy. That's an ugly situation for Europe. It's an ugly situation for NATO, and therefore it's an ugly situation for investors even in America. Now, in Greece, what you have is last week the Grecian government went to all of the public institutions and they raided their cash. So they went to the public universities, the public libraries, the public everything, and they took all of their cash to make the government's payments or be ready to on this note that's due. In addition to that, they've continued to make overtures to Moscow to develop a joint gas pipeline which could provide additional currency to the Grecian government. Well, this is a hugely important thing. Obviously, the markets are going to react when this breaks one way or the other. So keep an eye on it and stay tuned to the Master of Money for more information on that situation. Last week, I talked with you also about the Far East, and just yesterday, Monday, Japanese Prime Minister Abe was in town. He's actually in Washington, not Chicago. Forgive me for that slip. But in Washington, he's meeting with the powers that be to talk about the Asian economy. Most certainly, he's going to be talking about the Asian Infrastructure Investment Bank sponsored by China that you and I've spoken about in the past. They're also going to be talking about geopolitical military issues like China's encroachment on Japan's sovereign waters on some islands off the north coast of Japan. We'll have to wait and see exactly what that holds, but clearly we've got an issue there that could become much more important if the Japanese and the Chinese go into some kind of a conflict. I don't expect a military conflict, but certainly a trade conflict could happen. Also, we continue to watch the situation in the Mideast unravel. We know that Israeli planes just yesterday, or I guess it was Sunday, bombed some Syrian targets. And while this isn't really big news, it's more of an indication to you that instability in the global situation is there. You want to be aware of it. And what's that two-word phrase I tell you all the time? Risk control. Don't leave yourself open to these kinds of geopolitical problems hitting your portfolio when you're not looking. Economically speaking, the Fed governors this week will finish their first quarter meeting. This is going to be interesting. We know that as they come out, they want to raise interest rates. We've talked about that. But we also know from our friend Doug Roberts that watching the interest rates rise could be like watching moss grow on trees. Probably nothing to be afraid of. Well, the Fed continues to meet and dissect what happened in the first quarter. As you recall, we reported to you that the second, third, and early fourth quarters last year were very, very strong. Beginning about the last week in December and coming through the first quarter, the economy just stopped. And the economists, well, frankly, they have more excuses for it than a kid who lost his homework. We don't know outside of normal consumer patterns what happened, but we're waiting for the Fed's analysis to determine if they have any special insight that you and I don't have. I don't think they will, but we'll keep an eye on it nonetheless. We also this week will have the release of some more of the consumer confidence indexes as well as home builder numbers. So this should be a very interesting week in the economic data. And all of that, again, plays into how your portfolio is structured, how your investments are structured, whether you're retired, planning retirement, or just starting out. So make sure, as we talk about geopolitical and economic events, you're on board with us. And as I said, these confidence indexes, by the way, the most popular is the Michigan Index. I've talked about that with you before. The confidence indexes measure consumer confidence. And as consumers become more confident, they obviously spend more money. Well, there are a lot of things going on that can affect consumer confidence. And in just a moment, after we review the markets, I'm going to talk about two things that specifically can hurt investor confidence. But as we look at the markets, we saw mostly they were flat last week. They didn't really move. But of very real note to those of us on the institutional side, short interest actually went down a little bit. And what that means is there are less people institutionally taking short positions against the market than there were the week before. Can we really draw conclusions from that? Probably not. But it's interesting to note because that is a bullish signal. And I believe Monday we saw a little bump back up. We're certainly in record territory now. But as the markets move up, again, here's those two words, risk controls come into play. Now, the other things I wanted to mention to you today, just looking at what's going on in the world, we had a massive earthquake in Mongolia. And this was something that killed hundreds of people and injured thousands of people. Our heart goes out to those people as they struggle through recovery from this earthquake. It was really a powerful one, and that is going to be really difficult to recover from. So again, our prayers go out to them. If you have money that you donate to the Red Cross and other organizations, this might be an appropriate cause for you to do that. Also, if you watched the news over the weekend, much to the chagrin of all of us, we saw Baltimore erupt in riots. Now, the cause of this is a police issue once again, where a young man who was being transported to the police station magically severed his spinal cord and died. We don't have all the facts. We don't really know what's going on. But what struck me about it, and my feelings, frankly, in this might be with even the protesters a little bit, but the mayor of Baltimore came out and said she told the police to hold back and withdraw to give the protesters and effectively rioters room to do their thing. Well, you'll forgive me, but I think that's a mistake. There is at the core of some of this economic reality. And if we look at the sections of Baltimore that are being rioted in and looted of, what business is ever going to want to settle there again? And that does affect their local economy. I hope that the mayor made the right decision. This is certainly an unorthodox policy, and I'm not going to judge whether it will work or not. But I can tell you the outcome of it could just be that businesses no longer want to relocate there. And that could be a real problem for the folks in Baltimore. Now, on a less intense note than all that, when we come back after the break, I'm going to talk to you about an innovative new way to work with your money. It's called Folio investing. This has been developed or was developed in the late 90s, 98, 99, and gives some really interesting characteristics to investors like you as you look to build a portfolio that suits your personal needs. So stick around with us. We'll come right back after the break and we'll talk about Folio investing here on the Master of Money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the program. Once again, I'm glad you're with me today, and I'm glad that each week we can share some thoughts with you to help you build a more prosperous life. I know once in a while these topics can be really intense, and we try to keep it a little bit lighter. So anyway, I appreciate the time and the energy you spend to build a better life for yourself, and always write us at questions@safefinancial.org if we can help you in a specific way. Tonight, as I said, we're going to be talking about this folio investing concept, and there are really three things I want to touch with you. First, what is folio investing? Is it different? Is it unique? Or is it just words? Number two, what does make them different? What are the characteristics of these folios that make them attractive to investors? And then number three, I want to talk with you about who does it. If you hear after tonight or you listen tonight and say, hey, I'm interested in those things, where do you go? Well, I've got some ideas for you on that, one of whom is from my friend Jason Wenk. Now, you've undoubtedly heard about mutual funds, and you know about the diversification they offer. You know that there's a mutual fund to fit just about every investment need you could possibly have. I mean, there's gold funds, sector funds, you name it. You can invest in anything in a mutual fund. But there are drawbacks to mutual funds, and we've talked about this before. They're very expensive to create legally. They're very expensive to distribute, and you pay those fees. And because of the trading nature of mutual funds, you can only trade in or out of a fund after the market closes on any given day. So they don't have the liquidity of other things like exchange-traded funds that you and I've spoken about. Well, take the ETF world, take out the cost of the mutual funds, add back in the diversification, and voila, you get folio investing. This was actually invented back in the late 90s, as I said earlier, and it is truly an innovative way for you to build a portfolio. The idea is to take exchange-traded funds, no-load mutual funds, and other very low-cost instruments and build a portfolio customized to your specific needs. It's kind of a cool idea. Well, let's take a look at the 5 things that actually drive the uniqueness of these folios. Number 1, they can be fully diversified. Exchange-traded funds really are interesting. You and I've spoken about them many times. But you have the ability to buy into specific sectors, types of stocks, be they growth or value, commodity funds. You can even, through ETFs, buy into private placements, which gives you access to the non-public securities market. I mean, these things are very, very interesting, and they're very low cost. They give you trading flexibility because you can trade it like a stock throughout the day, and there's some tax advantage because you only generate a capital gain when you sell the ETF, unlike a mutual fund where you generate capital gains within the fund. So you've got some of these characteristics of diversification and cost built in. Second thing is customization. The way the folio industry has developed, there are providers who will build custom folios for you based on your own themes in the market. If you're a little older and want a more conservative approach, well, they'll build that. If you're younger and want a little more aggressive approach, they'll build that too. If you want to play a basic investment theme like, I want to invest in companies that are investing in China, you can do that. You can do all types of things with these folios, up to and including quantitative management. Now, if you've watched the Master of Money program for long enough, you know that I'm a little biased in that area. My success on Wall Street culminated with the development and sale of my company, Chicago Investment Analytics. Well, that company was one of the premier providers, if not the premier provider, of quantitative research back in the 90s. With 2 very bright partners, we built quite a research powerhouse. So I'm a little biased toward quantitative approaches to investing, and using these folios, you can employ a number of quantitative processes to customize it to your specific needs. It's kind of a neat idea. The third thing, and I mentioned this a little bit earlier with diversification, because you're using ETFs and no-load funds, the cost of folio investing is extremely low. It's much, much lower on average than you're going to find with just a standard mutual fund portfolio. So if you're looking, for example, as a sponsor of a 401k, you might want to consider folio investing for your plan participants. If you're looking now at shaving off some percentage points from the fees you pay these mutual fund companies, folios give you an alternative to that. And let me share the importance of that. If you look at the overall accumulated wealth from someone who generates an 8% return versus the person who paid higher fees and only generates 6%, it's exponential. One of the biggest lessons the institutions learn about investing is not to spend money you don't have to. So don't. If you can find a less expensive thing than a mutual fund, do it. It's the best way to happen. The fourth thing, and I mentioned this a little earlier as well, is tax benefit. Because exchange traded funds trade like stocks, well, you can trade them throughout the day and you don't incur a capital gain until you sell the exchange traded fund. Or if you like to do tax loss selling at the end of the year, you can sell ETFs and capture that tax gain. Well, that's a real nice flexibility to these folios. If you're using exchange traded funds, you've got the tax advantage very much over a mutual fund. And then finally, and I mentioned this earlier as well, but this idea of being involved in private placements. There's an awful lot of money in this country invested in private investments, private equity, private placements. Most of my, if not all of my investment money following the sale of CIA was put into private equity. The reason? You get much higher returns. And if you're smart about it, you don't take a lot more risk. It's genuinely sometimes the better way to play the game. Well, using exchange traded funds in these folios, you can actually play in the private placement world. That's hugely important, especially as we enter a time now where the markets are trading at 20 or 30 times earnings, depending how you look at it. We have those geopolitical issues on the horizon that you and I have talked about. When you throw all that together, maybe some fixed investments from the private investment world would suit your needs just fine. Well, that's something to think about. And if you'd like more information about that, please, please, please write us at questions@safefinancial.org. Now, I mentioned three things I wanted to do. I wanted to explain what folio investing was. I wanted to explain why folio investing is different. And third, I want to explain who some of the providers are. And this will give you a sense of the cost issue, by the way. As I said, folio investing was invented the late 90s, actually by a former head of the SEC, one of the SEC chairmen. And the idea was to provide a low-cost arena for investors to invest their money. Well, his company, called Folio FN, allows you to trade unlimited folios for the annual fee of only $290. Now, if you compare that as a percent of your assets, that's an extraordinarily low fee. And that's because the cost of these things is so low. Secondly, a very good friend of mine by the name of Jason Wenk established a company years ago called Formula Folios. The reason I like Jason's work is because, like me, he's a quant. In other words, he likes these algorithms that do the work for you. Jason's company manages a great deal of retirement money based on these folios. And if you'd like to learn more, we're going to have Jason on the program at some point in the future. I want to introduce him to you, and we'll talk about why these things work so well. But if you'd like information, as always, I'm at questions@safefinancial.org. The third company that I want to mention to you is called Folio Institutional. And this is a group, again, involved with SEC principals who has developed an institutional-grade folio investing capability. Well, they're up on the web at Folio, or I think it's called folioinstitutional.com. And the interesting thing about them is they create scalable folios that can be used on really large amounts of money. I think I've talked with you about this in the past, but there is a direct relationship between the inefficiency in the market that you can use to capture gains and the amount of money you have to invest. Let me be specific. If you have under $1 million, you can play in things like what they're called S&P mini futures. They're just really small individual investments. Well, as you get more than $1 million, 5, 10 million, you can't use those instruments because they're not liquid enough. Well, one of the problems that you can get in ETFs and folios is that some of them may not have the liquidity to handle a large amount of money. So Folio Institutional will address that issue by creating folios that can be used on really high levels of money. And that's something you and I could actually do a show on that, and I want to mention it. Another thing to look at when you're talking about which advisor to use, when you look at their track record, try to make a determination on when they achieved the track record vis-a-vis the number of assets they manage. It has been my experience after 30 years to see managers sometimes who excel with small amounts of money, but as that pool of money grows, the strategy they have doesn't work quite so well. So maybe when a guy starts out and he's managing $10 million, his numbers are spectacular. But when he gets north of 100, 200, 500 million, well, that same process may not work anymore. You want to be sensitive to that. And again, that's the concern of folio investing. Well, I appreciate your being with us, and I hope, again, you'll stay with us in the future so we can bring Jason on to see you and meet with you. But until we do get him on, it's always our pleasure to join you here on the Master of Money. You know, this program was developed by the Society to Advance Financial Education for you. We know that you need a friend in financial services. We know you need somebody you can call on that you can trust, who's not going to have biased advice. Well, we welcome you to reach out to us anytime through the safefinancial.org website and let us know your specific situation so we can help you. Well, tonight we've talked about folio investing. There's much more to go down that path, and we'll do that someday. And next week we're going to bring you another Master of Money with another topic we hope of interest to you. But until then, have a happy and prosperous week, and we'll see you next week for the next edition of the Master of Money.